You're listening to Conquering Retirement with Annuity FY. Real strategies, real stories, no sales pitch. Join Tom Hamlin and his expert guests so that you can make smarter moves faster. Hit that subscribe button and let's conquer retirement together. Welcome back to Conquering Retirement with Annuity FY. Today, we are diving into part 2 of the 8 Eternal Truths of Investing. So if you have not watched the previous episode or listened to the previous episode, stop, go ahead and, hit the stop button and go ahead and listen to that episode and then come back and join us here.
So you guys been wearing those clothes all week? Those same clothes? Oh my God.
All right. So, Brian, sorry. When you said that, I hit a button and I lost my intro. Hold on.
Oh man.
Hemi.
Sorry, I made you press that button.
And now she's blurry.
No,
Okay.
This was, of course, inspired by a client question. And just a reminder, you can write us too. You can. We'd love to answer your questions on air. And you can always visit us at annuityfy.com to speak to us directly. So the question is, just as a reminder, I've worked hard, saved diligently, and I'm retired. But with the market swinging and everything in the headlines, I keep wondering, am I doing the right thing with my money? What are the timeless principles I should be following to protect what I've built and to make it last? Wonderful question. Of course, when this client asked this question to Tom and we both immediately thought of something that Tom's always bringing up, which is the 8 Eternal Truths of Investing. And like I said, we've already gone through 4 of them. So today we're going to take it away with Eternal Truth number 5. Really quick, though, before I dive in, I want to introduce everybody here. I have Tom Hamlin. Tom is our wonderful star, and he's been in the industry for 35 years, has a lot of knowledge both in the investing business. He also has a background in real estate. So a lot of his knowledge really helps with these kind of questions or truths. Brian, I get to work with you every day as a colleague and a friend. It's great to have you here. You guys are both really equipped to answer these questions and go through these. So number 5, diversification is the best strategy.
Diversification is the best strategy. It's very true. It's the classic eggs in many baskets. When I think about this, I don't think about baskets. I think about those paper bags from the grocery store where they're always, the handles are always coming off, but you really want to just spread everything out. And I think the true elimination of all these types of risk is not I don't think that's really possible. I think what you want to do is you want to mitigate your risk in every category. So, instead of assuming lots of one type of risk, you're spreading that out over many different types of risks. And I think that's a lot more prudent, I'll say, generally speaking.
Tom,
My
looks
turn?
like it looks like you have something to say.
Ray. Yes. So Meg's right. Been doing this for a long, long time. And the reason I'm in this business is because I was in real estate, which I consider one bucket. And as I said in the previous episode, there's a bull market somewhere in the world at all times, regardless of what time it is. There's a bull market somewhere. But if you're in real estate and you're in one area, you're going to have to ride out the bumps, and they're going to be more severe, higher highs, lower lows. And the way you smooth out those bumps, and that's assuming you're in a good industry and you're in a good overall place. But the way you smooth out those bumps is through diversification. A properly diversified portfolio that covers many, many different asset classes and the different types of investments within them. We talked about value and growth. In the previous episode, we talked about a lot of different things. We talked about annuities. You need to have a properly diversified portfolio. You definitely don't want to get too greedy. And by getting greedy, I mean, you believe too much in one thing, which has you doing the wrong thing, which tends to be buying high and selling low, which has been a theme of these 8 eternal truths. So don't get sucked into that, okay? Because it's trying to suck you in. It's trying to get you to invest high. Look at all the euphoria right now in the market, okay? S&P's, within earshot of 7,000. Okay. That'll be a huge milestone. It'll hit it eventually, but it could be a week. It could be a month. It could be 10 years. You don't know. And so what do? You diversify. And most of the people that are in the business would agree that the market is overvalued right now, but the growth managers would definitely find a way to spin that and rationalize it. I listened to a lot of those people back in 1999 and 2000, and what happened? 2000 through 2002 was the only period where the market, the S&P 500 anyway, lost 3 years in a row. I like when people correct me on that because you have to go back to the Great Depression, and it was 1929, 30, 31, and 32 where the market was down 4 years in a row before I think it rebounded something like 53%. And that was 4 in a row. But guess what? There weren't 500 companies on it back then. There were only 90. I don't think it was until the 70s and John Bogle, Vanguard, that had it expand to 500. So I'm not an expert on the history of the S&P 500 in terms of as it grew, but those are some facts right there, based on my recollection.
So number six, thanks, Tom. Number six, this is this is the one that's probably gonna make some people a little frustrated. But money market accounts and CDs will not make you rich. Ouch.
Yeah, well, I don't think there's anything frustrating about it. Take any good sports team. You need offense and you need defense. So, right now, CDs, money markets are, paying much more than they do historically. But, if we look at a more quote unquote normal interest rate period, I mean, we're talking could be anywhere from less than 1 to, I don't know, maybe 2%, 3%, something like that. And yeah, I mean, you're not gonna get crazy rich off of that, especially when you compare it to something like the market. But once again, that doesn't mean you should put all your money in the market, because what happens? The next correction comes and, you're just wiped out completely, and you need income because you're retired and you have to sell everything, and you're selling it for pennies on the dollar. So every, good team has offense and defense. And, something like CDs and money markets are going to do their job very well in protecting what you have. And sure, you're going to make a little bit. But the main goal there is to preserve and protect and make sure that when you need the money, it's there. Tom, what do you think about that?
I have to respectfully disagree with my son, and I'll tell you why.
Oh,
Because not only do money market accounts and CDs not make you rich, if you want a guaranteed way to lose purchasing power every year since we started tracking these things for over 100 years, invest in CDs and money markets. Is Meg closing her eyes for an extended period of time, or is
no.
she sleeping, Meg? You
No, her
sleeping?
camera
You can-
froze. Her camera
Um,
froze.
oh, hi. Welcome back.
She's back.
Um, well, almost back. So, if you were looking for a guaranteed way to have your $1 million, as an example, be worth less than $1 million next year, buy a CD, buy a money market in a non-qualified account. Why? Because there is zero after-tax positive return after taxes and after inflation on CDs and money markets for as far as the eye can see with a telescope. It doesn't happen. So most people don't understand this. Playing it safe does not work. This is one of those things in life where it doesn't work. It's like curling up in a ball on a freeway. You're not going to be okay. So do not do it. That's where fear is not going to be helpful. Fear is good in certain times, like keep your head down in war or something like that. But when it comes to investing, being in CDs and in money markets, is not only not going to make you rich, you're not going to have any after tax, after inflation returns. And let's assume you have $1 million. What if you did beat inflation and taxes by 1%? Can you live off of $10,000 per million? Probably not. Probably not. Most people do not realize that their purchasing power is being drastically eroded by taxes and inflation, and it's more dangerous to be conservative and ultra safe than it is to invest in the stock market. Because the only thing worse than the risk of investing in real estate and diversified stock portfolio is the risk of inflation. Inflation is the biggest risk that we all face, and we have to stay out of it. Otherwise, your purchasing power gets eroded.
Well, let me ask. So, do you think there is no place in the portfolio for a CD or a money market?
I do when you're planning on redeploying it, and if you're looking for uh, short-term buckets to provide for cash flows, yes, but we can do it a different way. We can solve that with guaranteed lifetime income on SPIAs and on FIAs with guaranteed lifetime income and a number of other ways that will keep people ahead of inflation and keep people ahead of the tax man and still have a positive rate of return. So,
Yeah.
yes, you should have a certain amount of cash on hand, but you do need to understand that that cash is costing you money. I don't
Yep.
care if you have a 4% rate of return. Just understand after taxes, after inflation, you're not going to have a positive return. And so then what do you do? And that's why people should contact us, because we
Yep.
have a number of solutions for that.
Yeah.
Wonderful.
Great. Love it.
All right, number 7. Uncertainty creates opportunity.
Yep. It's very true. So, in the last week we were talking about speculation in part one, and what happens is there's certain, they can, when you take something like a stock or I mean any investment vehicle or anything, they're going to look at what how it's projected to perform over time. And the larger that kind of range is, the more volatile something is, the more potential outcomes there are. That could result in an opportunity. Risk versus reward. No pain, no gain. This all has to do with that. When something is uncertain in nature and someone takes the risk, assumes that risk, and it works in their favor, they're going to get paid more than someone. And it goes back to exactly what we're talking about with the money markets. The reason that those, money markets and CDs themselves, especially in non-qualified accounts, where, if you're getting taxed as you go, the reason why that those aren't returning 10% is because the outcome is certain. You're not taking any risk. And I've had this conversation with a client before. He wanted a MIGA. He wanted to earn. He had let's just call it $500,000. That's not the number, but we'll just call it that. And he wanted to earn what was it? The income figure added up to 10% of 500,000. I said, you can't get that guaranteed. You're not assuming any risk. There's no uncertainty there. You know what you're going to get. No one's just going to hand you 10%. You have to assume a certain amount of risk to get that figure. What do you think, Tom and Meg?
Although some guaranteed lifetime income products come very close to that figure if you defer for 1 year,
Yeah.
and it's guaranteed for life. But yeah, uncertainty creates opportunity, I would say, is one of the most impactful, important things to remember. Most people forget it. They feel that uncertainty means that the sky is falling, that things are horrible, things are going to get worse, things aren't ever going to get better again. There's an old adage, the good times don't last forever, but God willing, either do the bad times. And everybody knows the first part of that. And historically, what goes down, what goes up goes down, and what goes down goes up. And there's another saying, blessed are the risk takers, for without them, nothing would ever happen. There's a whole lot of people that take a lot of risk. They're not on, and it's nothing to do against with anybody that's on a salary or anything like that. But there's a number of people, myself included, that are, entrepreneurs, that are risk takers. And, I've been I haven't had a salary since 1988 unless I paid it to myself. And, it nothing is more inspiring than knowing that you don't have enough to pay your bills and knowing that you need to make it happen. Winners make it happen and losers let it happen in this lifetime. And, it's the people that can actually, doesn't matter, where your income's coming from, but where you can actually say, okay, realistically, the market sold off, whatever it is, 20%, like it did in 2022. Chances are it's going to rebound, and it's probably a good time to put money back into it or to add more money into it. Um, Meg's about ready to say something, I can tell.
No, I think this kind of leads to number 8, which is never say never. These all have kind of tied into each other, as if one can tell. It's actually been a nice flow. But yeah, never say never, right? I mean, that ties in with uncertainty so much.
Usually, usually it's the people that are naive that's utilize never say, or that think that say never when markets are high. The market is going to keep going up because of AI. Back in 1990, in the 90s, it was .coms. This is revolutionary. The internet, everything is just going to keep going up, 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 and up. So it's never going to go down. Those are naive people. And conversely, if somebody's saying that the market's never going to come back, we're never going to be able to get these things because it's never going to be good again. Those are the naive and the people that don't know how things work. So it takes a lot more courage to be an investor when the market has sold off dramatically and people have capitulated. They couldn't sleep at night. They were visiting the bathroom and many times, and um, and and they just they have to sell off, and that's because their risk tolerance was not properly diagnosed. And I would say that's pretty good, diagnosed, because it is a diagnosis, and you need to have the right cocktail mixture of assets and holdings in your portfolio to be able to function properly, which means to be able to withstand the difficult periods that we've had in the past and that we're going to have in the future.
Yeah.
So I encourage everybody to be properly diversified. And most people get buy low, sell high backwards. And where's the market right now? Have you considered, and I say this to anyone and everyone who's listening, and don't forget to hit the like button and subscribe. We want to bring you more great information. But I encourage everyone to look at their portfolios and say, okay, if I was supposed to be 40% in bonds and 60% in equities, kind of your traditional balanced approach. And now, because equities have run up in 5 of the last 6 years, safe to say, unless something really drastic happens in the last 3 months of the year, it's going to be a positive year. And it could go backwards. 1987 was a lot like that on October the 19th. But the bottom line is that, is it time to lock in some gains? Is it time to take some of that money off the table? Is it time to lock in guaranteed lifetime income before interest rates go down? Okay. Or are you believing that the stock market's just going to continue to go up, up, up and away in my beautiful balloon? I don't think it is. I think that we're going to have a great 10-year period in the market. But I don't know what happens in between now and then, other than it's going to be up, down, all around. And and you need to take some of that money off the table. That's called value averaging, by the way. And that'll be something else we'll talk about in the future. Value averaging is rebalancing your portfolio real quickly, because your stock portion has probably gone from 60 to 75, 80% of your portfolio. Well, the bond portion has gone down proportionate to that. And you might be as low as 20% in bonds where you're 40% below, and as high as 80% in stocks where you're 60%, and you need to rebalance. That means sell high, buy low.
All right. Well, thanks, Tom. I know we could have talked so much longer on these, but this is kind of just the basics for the 8 eternal truths. I'm going to go over 5 through 8 again, just to kind of recap. Number 5, diversification is the best strategy. 6, money market accounts and CDs will not make you rich. 7, uncertainty creates opportunity. And of course, 8 is never say never. Thank you so much for joining me, Tom and Brian. I look forward to the next time. And, go ahead. If you have any questions, please go ahead and put them in the comment section so that we can review them and perhaps talk about them on a future episode. Additionally, if you have any questions that you don't want to put in the comment section, and if you'd like to speak to a professional or Tom or Brian, go ahead and go to annuityfy.com and speak to one of us even today. Thanks so much, guys. It's been great having you. And thanks for going over
Thanks,
these
Meg.
truths.
Thanks, Brian.
Take care.
Appreciate you guys. Have a great
See you
weekend.
next week.
Thank you.
Thank you.
That's a wrap on this episode of Conquering Retirement with Annuity FY. Ready to take control of your future? Call 1-866-223-2121 to speak with one of the guests on our show and get your questions answered today. Visit annuityfy.com for more information and to contact us online. Follow the show and make sure to turn on notifications so that you'll never miss a tip, strategy, or breakthrough moment.